How you doing?
Hi.
I just got the car yesterday. Hopefully it's gonna be all right. But you know what? I'm walking, so.
Exciting.
Thank you for coming. The dedication.
Oh, I love it. I love it. Like that was a very valuable talk yesterday. There's so many good tips. I was like typing out.
That's awesome.
Yeah.
Can we get that on recording?
I can share with you my tips. Yeah, I really find it like seriously, I really find it valuable. So.
Awesome. Thank you. Yeah.
Thank you.
Hello, can you hear me?
Yes.
All right. Hello, everyone. Thank you for coming to day 2 of our Product Growth Conference. We're super excited to have you guys, and thank you if you came yesterday as well. So just a little bit about myself. My name is Imran Rahman. I'm the president of Piedmont Consulting Group. We work primarily with startups. We put 8 to 10 Berkeley students on a project, and it's like having a bunch of Berkeley interns working for you for an entire semester. But just about the agenda, we'll be doing a speaker panel that's about 45 minutes, and that includes a Q&A. And then we'll be changing the venue down to North Beach Pizza. It's about a 10-minute walk that way, and that'll be around 3 p.m. And before we begin the speaker panel, I just want to shout out some of the partner organizations that we've been working with to host this event. So I'll begin with Honest, and I'll hand it over to Sam or Alex to talk about Honest.
Everybody, thanks for showing up today, and thanks to all of our repeat customers today who stopped by and definitely some familiar faces. It's awesome. Yeah, thank you, Zemran, and thank you to PCG and everybody else who's been involved. It's been an awesome experience. Not just working with these guys, but working with everybody at Berkeley and SkyDeck and everything. It's been awesome. But a little bit about us, Honest. We're a product growth studio, excuse me. We work primarily with early stage startups on developing product growth strategies, helping them try to get from one inflection point to the next, help scale up and do fun things so you can be nice, grown, and successful. So it's a little bit about us.
All right, thank you, Alex. And then I want to do a shout out to SkyDeck for letting us use this venue and bringing a lot of the founders. So I just hand it over to Ekin.
Thank you so much all for joining us today. My name is Ekin Güneş, and I work as one of the program managers at SkyDeck. I will just keep this very brief. Berkeley SkyDeck is part of UC Berkeley, and we are the premier accelerator of the university. We have 2 batches every year. We have an accelerator program and an incubator program, and we work with 300 startups every year. I will be here after the event, so if you have any questions about our program, I'm more than happy to connect. Thank you so much again for coming here, and hope you enjoy the event. Thank you.
And our third and final partner organization is Young Entrepreneurs Hub. So I'll hand it over to Eli just to talk about that.
Yeah, so we're Young Entrepreneurs Hub. We came in as a co-host for this event. Simon and this club were one of the main people for building this, as well as Honest. And yeah, we're just stoked. We're based here in Silicon Valley, but we're a global founder-focused membership community, and we do events as well as get to know founders and introduce founders to the people they want to meet. Come reach me or some of my other team members here, like Kevin, who will be here soon, and yeah, talk to us. We'll tell you more about what we're about, and we have a bunch of events today.
And just want to thank our 2 sponsors. We wouldn't be able to do this event without them. So I'll hand it over to Carl to talk about Alumni Ventures. He's also one of the panelists as well.
Thanks for putting this together. Just quickly on Alumni Ventures, we're the largest VC fund in the US for individuals. So we have communities around over 30 universities where we raise money from, have over 10,000 actual investors, but more broadly speaking, 600,000 people that we serve. And we invest very broadly across different sectors and stages. The idea is to democratize VC asset class for individuals. So we were the most active fund in the US last 2 years according to Fitchville, and also was recognized as top 20 VC alongside with Sequoia Investment and other top names. So if you are interested in becoming an investor or if you're building something interesting, please reach out. Our website is www.av.vc.
And then the final sponsor is Edge Case Capital Partners. I have Jaden and Jessica to talk about that.
Thanks so much for having us, Zimran. It's been wonderful. I'm Caden. This is
Jessica, nice to see you all.
so I'm the founder of Edge Case Capital. We're a pre-seed generalist VC firm. We do 25 to 50K check sizes, and come and meet us. Thanks so much for having us.
All right, so we will begin the panel. Let me just introduce each speaker individually. So I'll begin with just an order. I'll start with Sam. So Sam Gimbel has been leading product teams in New York City since 2010. He was the first product hire at Drama Fever in 2012 and at DigitalOcean in 2014. He co-founded and sold Clark, a SaaS platform for tutoring businesses, in 2019. Since then, he has built product teams in the SMB and FinTech, most recently as VP of product growth at Clover Networks, where he led point of sale and consumer efforts. And Sam will be moderating the conversation alongside Alex. And Alex Meredith has been scaling early stage startups for the last 15 years as an executive, operator, and advisor, and has been a key member of 4 acquired venture-backed startups. Prior to starting Honest with Sam, Alex served as the director of product growth at Clover Networks and the VP of growth at Minibar Delivery. And next up, one of 3 of our panelists is Carl Choi. He is a senior principal at Alumni Ventures and brings more than a decade of experience in venture capital, corporate development strategy, investment banking, and public equity investments. Previously, he was a principal at Solasta Ventures, responsible for enterprise software investments, including the future of work and climate tech. Earlier, Carl led strategic initiatives at Upwork and Riverbed Technology and spent time at JP Morgan in San Francisco. Our second panelist is Ellen Linardi. She is a product leader, advisor, and investor with background spanning engineering and product at Intuit, Symantec, and Clover. She has built organizations that have scaled products for use by hundreds of millions of users globally and led the integration of high-performing product organizations into large public corporations. Ellen recently joined Sigterra, a banking as a service platform, as Chief Product and Technology Officer. And our final panelist is Sahab Aslam. She is a seasoned professional with an extensive experience in data science, product management, and software engineering, having led digital product development in fintech and digital health for startups and Fortune 50 companies. An active angel investor, she supports early stage startups in health and wellness and enjoys mentoring and coaching founders, especially women founders. And currently, she's a mentor at Berkeley SkyDeck. So I'll hand it over to Alex to begin the conversation.
Thank you, Zimran. And also, this is a very applause-happy audience. I love that. So keep it up, guys.
Yeah, keep it going, please.
And yeah, also just thanks to our panelists. And I thanked a lot of people when I had the mic earlier, but I didn't thank our panelists. So before we even get started, thank you guys. Really appreciate it. Awesome. Sam, can you kick us off?
Yeah, let's go for it. So, thank you again for your time and for participating in this discussion. So the spirit of the conference over the 2 days, yesterday was really focused on concepts of product growth in a more sort of tactical micro context. We talked a little bit about product-led growth, how to think about your North Star, and so on and so forth. Today, we want to explore the more macro side of this. So in particular, I think something that's on every founder's mind, anybody who's looking for a job, anyone who's thinking about what's next in their lives, it's what is this new economy? How do we fit into it? How do our companies fit into it? And in particular, around 2022, maybe the end of that, early 2023, we saw VC start to change. money got more expensive, just from an interest rate perspective. And we saw with Silicon Valley Bank that we're in a fragile environment. Maybe we always were, but it was a reminder. So as we think about that, we're seeing VCs do fewer deals, take longer, and we're watching the goalposts start to move a little bit. I'd like to, start with, let's start with you, Carl. At a high level, what's your outlook across the market? And maybe we can start to dig into specific segments as we go for VC in 2024 and 2025.
Sure. Yeah, I'll start our perspective first. And obviously, as you guys all kind of gone through, 2021 was abnormal time in my opinion. And then we're sort of in the process of normalizing. And our firm in particular, we try not to time the market. So there definitely a slowdown in terms of overall VC market. But at the same time, we're starting to see some bounce back. So I think the latest data I saw for the Q1 2024 was up 16% quarter over quarter in terms of VC activity. So we'll see if that's going to continue. I guess rest of the 2024, 25, I don't have a crystal ball per se, but I think it's going to be probably different for different industries, and depending on what you're building at, we've seen kind of steady and even like very strong growth in AI, and some sectors in energy and healthcare we're starting to see coming back. So yeah, depending on the sectors, I think you'll have different perspectives. And towards the end of the year, I think people are getting a little more optimistic. The other big factor is the rates, and so how the Fed is going to play there. It's going to have a first degree impact in the public market initially, and then that's going to kind of flow down to the earlier stage. So we're, I guess, overall cautiously optimistic and try not to stop in terms of deployment or investment.
Awesome. And how are things looking in the banking as a service space?
So I was actually going to say, this is my probably real dip and dig into startup, right? We've been on the other side for the most part. So I've been on the acquisition side, I've been on the mentoring side, evaluating startups, purchasing startups. So I decided to kind of go into it myself this time. And I would say that the general venture market actually seems like it's beginning to look a little bit more optimistic, just because valuation across the board has gone down dramatically, right? So it's in some ways it's a friendlier market for VC to start coming in and participating again. I think I saw data that the venture investments almost as lowest in the last 15 years, which means that if you look at the chart, it normally kind of hikes down right before it picks up again. Right, but I think if we look at valuation the last several years, whether that's from an acquisition perspective or anything else, it's just outrageous. And most venture goes in either looking for an IPO or an acquisition, right? Both has become very difficult to come by. So I think people are a little bit more tight with their money, and the bar that's required is no longer conceptually, is it interesting enough, but do you have proof, right? Is there traction? Is it not even just traction, but is it a large enough, interesting enough market? I think those questions are being asked more. So my take is it looks like people are actually beginning to engage again more now than they have been the end of last year, early this year. I know a lot of startup has been skipping going full round and just going bridge round, just because it's also, it's tough for everybody. So people kind of want to sell when it's high and not when all the valuations are real low. But I think we're getting towards the inflection point where hopefully towards the end of the year starting.
Yeah, I can speak from an angel investor perspective. Oh, sorry. Yeah, I can speak from an angel investor perspective. So I actually started angel investing in 2021. So I have no idea what happened before COVID. I don't have a baseline or reference.
Neither do I, because I just don't remember it. But
but when I started, I saw really interesting companies. I guess that was more normal at that time. And then all of a sudden, we started seeing influx of companies that were venture backed, not really, I would say, pre-seed stage for an angel what an angel investment would look like. And a lot of them were not being supported by their VCs anymore. So they were going and there were a lot of down rounds. So this is another thing. These companies were so high, the valuation was so high when they got their last funding. It wasn't the best thing. And right around that, we started losing our pipeline of good investments because they actually started going towards the VC. Many VCs started going towards early stage. So it's been kind of an observation. So it becomes, as an angel investor, it became harder to find the right deals as you would otherwise. So right now, I think the market is getting back to some point. It's going to get there. But at the end of the day, if you have the right fundamentals, you will be able to get through. So because this is where the bridge round comes in. If you have the right fundamentals, angel investors may come in and help you with your bridge round. But think of it this way. When the economy is not doing well or when things are not going well, large corporations start cutting off their staffing and start cutting off their budgets, and they can still operate. But if you're a small company and you're just starting, you don't know what to cut, you can't cut it. And if you don't get the funding, you can't move forward. So there is a push from, I think sometimes as venture capitals as well. I'm not as sure if that's the case, but at least angels ask, like, what's the path to profitability as fast as possible? Are you thinking about operational costs? And all those kind of questions are get asked in due diligence, because we don't want to be in a situation because there's nobody to support if angel investors are not supporting the company. So there's nobody to fall back.
You guys all, I'm just going to talk really loud. You guys all kind of hit on a really interesting point.
One, two.
Yes.
All have an interesting kind of a common theme, but like talking about fundamentals. And I think like that's kind of the key that we've all seen, whether as an investor or an operator. The focus is certainly on the fundamental aspect of things. Certainly, speaking from like a growth standpoint, gone are the days of getting a nice seed round that you think you can just spend a bunch of money on UA campaigns and scale your company that way. It's a very different market than it was today. And I think a lot of what Sam and I have seen more recently, a lot of conversations about companies that want to figure out more efficient ways to scale, and it's all because of the money coming in. You're not getting nearly as much money in your early rounds or later rounds for that matter. So there is a lot more of a focus on the fundamentals, on how are you going to scale your company in an efficient manner, and focus on retention, not a bunch of UA campaigns and things like that. So it's been interesting to kind of see that trickle down throughout to like the companies in the fascinating.
Yeah, and I think what I'd love to hear more from the three of you about, especially for companies that we're working on those fundamentals and building a reasonable amount of momentum. It is difficult for them to sort of cross this chasm. Sometimes they go with bridge rounds, sometimes they, cut staff, or they cut targets in some way to preserve cash. But at the end of the day, they're now trying to reach milestones from seed to Series A, for instance, that have absolutely sort of increased. So how do we think about that? Like, what advice do we give to founders, or how do we operate as product leaders, to try to do more with less without burning ourselves out or burning out our engine?
I can start on the VC perspective. Like it was talked about, we do care about metrics, and especially these time of day, the numbers matter, and if you have good numbers, you'll have no problem raising. And I don't know if you guys know David Sachs. He's in the All In podcast, so he's a little more popular these days. He had a post and some writing about right when the pandemic happened, about the concept of default investable versus a default alive, and he put down some of the metrics, and the actual numbers might move a little bit. I kind of concur with some of the things that he looked at. Is a prolific SaaS and software investor, and some of the metrics he look at and we look at as well as the growth on the top line, as well as gross margin, And net dollar retention, if you are not familiar with, I'm sure most of it are, in terms of like how much additional dollar you get, and then I guess one more metric at the bottom is net burn multiple, which is net burn over net additional ARR that you're getting for the quarter. And I feel like there's actually more emphasis on that. I think as a startup, especially on the early side of things, you have to manage your burn and kind of push out the runway. And that's one of the key metrics that we've been trying to get more and more. So as a founder, as an early employee, definitely keep paying attention. But overall, like more measured growth, thinking about profitability.
I think on the operator side, something to sort of really pay attention to, especially in the early startup days, is the fact that during the entire life cycle, you might have to flex different part of the business, right? What we've seen is, and I think this is both within my current role as well as like previously, there's a growth stage that happens during the early build stage, right? So you might have like build a bigger product design engineering team. At some point, you might then need to start operating. So you start hiring a bunch of people. Now, when funding is great, you hire everybody all at once, right? The reality of the market today is that when you flex one side, the balloons get smaller on the other side, which means that there's actually probably a lot more rebalancing and cutting that's required in order to have that longer run rate, right? And so I think that's thrown a bunch of founders off because that wasn't how we were operating 2-3 years ago, right? It's like you build your product and then you're like, now I want to run ops. Give me more money to run ops. So the reliance on fundraising in order to have runway was, I think, much more reliable before than today, right? Like today, if you say, hey, this is roughly your run rate, how do you maintain your run rate and be able to flex different aspects of it? It makes it difficult because that means you probably have to let go of part of your product team to hire sales, part of your sales to get ops, right? And so the prioritization within your internal functional group becomes a lot more important. And that requires a conscious effort and a conscious, I say, leadership, change management, which also a lot of startups might not be great at, right? Like you might be first-time founder, those are difficult. But I think the dynamic in the market right now requires the founders, the leaders to actually do that more elegantly and be more mindful that that is something you're going to have to do as you're navigating through this journey, right? Even if you're going to get to Series A, you're going to get to Series B. The journey that it takes to get there now looks a little bit different.
Yeah, so one of the things that I see comments from working in corporate data, working in corporate and data and working with founders when they're, showing me metrics, I see a commonality and I call it a lag metrics. Sometimes they're measuring something that's an aftermath of what they actually wanted to change. So it could be number of users they acquired, and number of users acquired is a metric that will help you get an investment, but it's not the metric that will help you grow. You would have to figure out what are the tactical metrics that you need, and you need to track them so that you get there. But sometimes founders think, oh, I need to get this many metrics aligned so that I can get my next round. Investors will come in. And I've seen sometimes over-focusing on that one and not worrying about operational cost. Sometimes there's a growth metrics and they spend too much time and effort. And sometimes it's a lot of stress to take on as well. So think holistically, always follow your gut. Your gut is the best thing you have. And maybe it's some other metrics you need to tweak that may get you there. But if you just think of that, then it just makes it a bit more difficult to grow. So I'll give an example. If you are a CPG company and you sell it to stores, and you need to be at 10 million sales to get acquired, and that's where you focus on. I need to get 10 million sales, but your margins are very bad. You're not going to get acquired. So you need to think holistically. What are the metrics that needs to happen, and then every single step you need to be strategic about it.
It kind of goes back to the fundamental things, right?
Yeah.
It's actually something that came up in yesterday's event, and we were talking a little bit, for anybody who was there when Nathan was talking about at Box, like they were really 80% of their customers, 80% of their revenue was coming from, the retained users. So they spent obviously a lot of time focused on those users. as opposed to just acquiring new users all the time. An example from, my experience, I ran growth at an alcohol delivery company during the pandemic. We got new users pretty easy. It wasn't that hard. They would come in because they're stuck at home, middle of the pandemic, like they wanted alcohol.
This is in New York too.
This is in New York, even more alcohol. But getting those retained users over time, especially once the pandemic started to, once restaurants and everything started to open back up, once things started to open back up, then that's a different challenge entirely. If we were we were eventually acquired, but if we were trying to get acquired at that time, just focused on new users entirely, very different situations opposed to focusing on those retained users once, the pandemic started to die down a little bit. Once we could prove out that, a lot of these users that we picked up during the pandemic, we can get them to come by for not just that first bottle of alcohol, but I can, if I take 90% off the first bottle of alcohol, I can sell to any user almost. But if I can get them to come back a second time, that's a different story without giving a discount on that alcohol. So it becomes much more important to get those retained users. Again, fundamental.
And a little bit of what Alex just said, right, on the fundamentals, I think sometimes there's a lack of focus on the actual value that's being delivered, right? So there's a lot of focus, like sometimes you optimize for growth. So you're looking for metrics to just get more customer, sell more things or anything else. But I think the focus, regardless of which stage you're on in building a product, focus on actually delivering value for your customer. So important, but so easily forgotten, right? Because that's not what might be your leading indicator or anything like that. You might be able to get them the first round, the second round, but without actually delivering sustained value, it's just going to erode, right? And I think with the much tougher market, the scrutiny on actual value is going to increase in general. So the better job you do as founders to kind of take a look at your own, fundamental value, whatever we call it, the better you're going to make it on the long run.
Yeah, I think I'll second that because as a data science specialist, AI specialist, I get a lot of founders asking me, how can I add AI? This is what I do. It has nothing to do with artificial intelligence not needed. And I'm like, why do you want to do AI? How do you see it improving it for your users? And they say, because investors will invest in a company unless it has an AI component in it. And AI is expensive. So many of these founders are not technical, so they will have to hire very specialized people. They don't know if this goes right. They're so much complicated. It's less of a value, more of a liability at that point. And they build this tech deck, and then and my point of view is that you're talking to the wrong investors. You want to find the right investors who believe in you, who believe in your idea. There's value there. Build it for your users. That everything you do should serve your users and customers. Because at the end of the day, that's what makes a great company. That's why you started that company. You didn't when this focus starts shifting, because there's a blockchain, AI these days, it just makes it more difficult to run a company when you have shifting focus.
And finding that, that center of focus is all about alignment. So you have your alignment with customer value, but actually it's easy to run a company into the ground if you only focus on customer value, but you don't find a way to align that with the business value. And then on top of that, what are people investing in? And then what does the market actually need and where's it going? And coming back to balancing out your team, is also the cultural alignment. Can you build a team around this mission? And it's almost as if you need, like a central narrative, a central, metric or direction, such as a North Star, that would actually allow you to, sort of orient the conversation around. One of the most difficult things that I've dealt with throughout my entire career is figuring out if a company really understands what that North Star actually is. And, what I see a lot in founders these days, this year, is that the sort of frenzy of building a thing, getting it out the door, getting as many customers as possible, was the urgent and important piece, but they weren't looking at just the sort of important but not necessarily urgent piece because it was not necessary to get their next investment of actually understanding what their business is. And I think there's a lot of existential angst right now amongst very smart, very capable founders of teams where they're really having to rethink, how they approach this. And so there's a very human element to getting these things in order. What advice do you give to founders of teams that are coming to you with this type of almost like breathless sort of white knuckle, I don't know what to do, sentiment? Do you even see that? I certainly do, but I just
keep it up. Sort of varies as well, right? So it's it kind of depends at what stage you are that you're white knuckling. So I'm trying to think of a generic answer to that, but I think it comes down to a certain amount of it. I think it comes down to first understanding what you actually have conviction on, right? And I think if you're starting a startup, it's okay, what is it that I have conviction on? Is it on the hopefully a particular problem that you think you're solving? And I think if you start from there, the flexibility on how you get there and the willingness to actually step back and look at it and say, hey, the problem might be right, but how we go about it might not actually be ideal, right? So the white knuckle can happen due to many different reasons. So you can have white knuckle because you have the right problem but the wrong path. You can have that white knuckle because you have the right problem, the right path, but the wrong team, right? You could even have white knuckle because you have the wrong investor. And I think, be very careful about where you are on that process and sort of evaluate, maybe start with evaluating the cost of the white knuckle, right? Because I think that will point you to what are the actual problems that you need to solve for and whether or not it is existential, right? I think especially in the early stage, even who you've chosen to fund your organization, who you've chosen to work with, I think has a dramatic amount of impact on how your organization will go, right? They actually have to buy into your idea, your concept, and maybe I'll say not even just the funder is important, even your customer is important, right? Don't sell to people that need what you want, sell to people that believe in what you're building, especially if you're early on, because it's going to be bumpy, it's not going to be perfect. So you have to, I used to talk about similar spirit animal, so you want to find people who kind of have shared similar understanding and desire, and they're going to be a lot more forgiving in this process, whether you're a customer or they're your VCs or whoever else that you're working with, or it's your team member, right? So I think that alignment on intent and goal is important. Maybe my advice is to find where the white knuckling root cause come from, go from there, and then sort of reflect back to who you have relationship with and whether those relationships are actually aligned.
That's actually a really interesting point, Ellen. You're right. If bringing in the wrong investor can certainly cause extra stress. We're talking right now about just being in a different environment entirely. Has looking or as trying to find an investor today, when you look for an investor today, has that shifted at all because with the changing environment? You guys feel like it's any different than it was? Do we still look for the same fundamental? Do we still look for how has it changed when we look at an investor 3 years ago or 4 years ago when a lot more money was getting doled out? Now, when things are a little bit tighter, do we look at finding an investor any differently?
I can share from my perspective as an angel investor. So we do talk to lead investors if there is one, happens to be a VC. And it's a huge consideration because it has turned out that there are few lead VCs were not even involved with the company. They just had the philosophy of spray and pray. And we see a lot of potential with that company, but we feel like they don't have the right people in the board to mentor them. And as a small checks or, we don't have that influence power, we can guide, but we can't be there all the time. So your lead investor is very, very important. It's a partnership. It's not just, in a capital gain. So when you get the right lead investors, other investors follow, and everything falls back on its way. So investors are important, and sometimes I've met founders that say, "Oh, I don't want to do angel investors at all because I have VC lined up." While they don't realize that there's some amazing angel investors out there, it's not that the capital they bring tons of network. They know the people that they can introduce you to will buy your product. They can help you with regulatory issues. They can help you get in the market. So sometimes it's nice to do some research on the people who are willing to write the check. They can bring more value than just capital.
I agree with her points. There are so many flavors of VCs and investors. And in my opinion, I think money is getting commoditized. So you can find capital from really anywhere, but you should, to her point, really do research. And as like us investors doing reference checks and works on you, you should look at the VC firms, and everybody has different themes and what they can bring. And obviously, if they've been around, you should talk to other founders that had investment from the firm and do your diligence finding to your right partners, because it is, to your point, it's like a marriage. You'll be stuck with investors for a while.
So just thinking through that from my own experience raising, and I mean it's really true. I raised my seed round in very almost bizarre circumstances that we won't go into here. But if you want to ask me later, we can talk about it.
I highly encourage it. It's great.
It's a great
That's a lot of
story.
bizarre story.
Yeah, it's a great story, but it's not germane to this conversation. But like the investor that you end up with, especially in your seed round, is going to end up on your board, and you want to make sure that there's somebody who brings something to the table that you don't have, or someone who strengthens a strength that you need to level up. Somewhere, one of those two. And it's similar to hiring, right? Like if you're a good hiring manager, you're going to bring in people on one end of the skill set that can complement, people who are, either more or less, say, autonomous in the working style, so that they can complement each other and fill out the diagram. But when we're thinking about specifically, those first few hires, I want to sort of orient ourselves towards that a bit. Because we do have to be thinking about who we're hiring first. There's millions of options these days for outsourcing, pick a thing, sales, of course, engineering, even fractional roles are becoming a really big market these days, or at least there's a lot of talk about it. And whether it materializes or not is, outside of CFOs, is an interesting topic. What advice do you have for earlier stage founders hiring their first, let's say, 10 people, for qualities to look for and things to emphasize? Like they're just getting their MVP out the door. Customers are seeing it for the first time. What now?
Yeah, I'll just keep it brief, and you can probably add a lot more. In our perspective, especially in the early stage, I think you almost can't overspend time in hiring the first few hires. Obviously, the co-founders most important, but then first few hires, I think that just cements your culture going forward. So I probably not, even though I worked at Upwork previously, that's more when you're down the road and can scale. Like first few hires, like spend your time, due diligence, and make sure that you're finding the right person. Like mishiring costs a lot, and not just time, but money, and can set you back for several months. So that's just my thing.
I think for hiring, definitely, spend your time. It's a courtship. I would say even while I was looking for switching out into the job and doing various interviews myself, right? I was looking for people who hire as a courtship. Because then it's more of a courtship. It's not an interview. You can tell in the meeting, you meet, then you do coffee, then you do more chat. Like it's like dating, right? But it's a little bit different than when you go to an interview and someone's just interested in interviewing. I find the folks who are just interested in interviewing are going to have some worse hired because you don't really look for compatibility, right? So you're gonna spend so much time together, you're gonna have so much ups and downs together that you better make sure you get along, right? So that's number one. The other thing that maybe is worth sharing in general for any of the team members you're hiring early on is I find it incredibly important to hire people who are curious, right? So sometimes you hire folks who are deep subject matter expertise. They are really good in one area or another, but let's face it, it's a startup, nothing's well-defined. Something that you think is A today is Z tomorrow, right? And so you need people who are able and willing to sort of flow with the changes of the organization. And there's a lot of folks, and this is not just your first, your 10th hire. I think your 30th hire, your 40th hire might still be like that until you're a large, truly large established organization. Find people who are curious, who are willing and are interested in the problem, because that is the part that's going to evolve and keep them excited. Otherwise, people get burned out really quickly. They get, kind of a little bit disappointed that they're being moved around. You're like, it's not consistent. It's a startup, of course it's not consistent, right? So finding people that actually get excited by that unknown and that space, I think is really important, because then they will actually scale with the organization, right? And hiring takes a lot of time and money and cycle, so you do want to do it carefully.
So I've been given advice, all sort of advice. Don't invest in a solo founder. Don't invest in a team they may find. Don't invest in a husband-wife co-founders. And I've done it all, and I can tell you, it doesn't really matter. If the founders are right, the company works well. So the kind of things that I look for is, when you go in pitching, we interact. And if the CEO is the only person talk during the whole pitch, we kind of feel weird because you want to hear from other teammates as well. If it's a technical company and you're missing a CTO, and you say, oh, I just outsourced that, that could also signify that you as a technology company are not seeing it as an important enough that you want to have a person who can own that piece. So there are founders that are very smart in a way that they know their strength and they know where they need support or they need the kind of skills to augment that. And it's very quickly, you can tell them that they even tell, with this kind of funding, I'm going to hire this. So bringing that kind of humility is very, very helpful. And let's say if you are expert in your area, but you're still open to hear more, that's also helpful, because this is how you're going to work as a team. So it's like, you are a team, but going back to the courtship part, co-founder, even the early team hires are like partnership. It's not an employment or business part. It's a different kind of partnership, because you don't just close and go home. You take work with you, your family gets involved. You are too involved in your startup. And if you don't get along, if you have a partner, go as a group, see how it goes. Do you share the values? Because when things are going well, it works well. But when things are going tough is when, you see the arguments. And you need a person you can work with in those times. And that's the most important part. So it's all the other things that matters. And shared values is always helpful. You just talk and learn, not just about work. And another thing, last thing that I'll add is that if you're hiring early employees, don't look for somebody who's looking for a job or something. They just want to be part of startup, get that experience, or build something fun and shiny with you. Pick somebody who's passionate about the problem you're solving and the users you're solving for. They're passionate about that, because they're going to stick longer. They will see the value of their work bigger than something that they will put on their resume.
And just a little add-on piece of founder advice. One of the best things you can invest in is couples counseling, preventative couples counseling at the beginning of an engagement with a partner. I had a startup in between 2016 and 2019, possibly the best spends that we ever made, other than hiring Alex, of course, was Just jokes, of course, but very valuable. The most valuable spend was definitely hiring a leadership coach for the two of us, younger coach. And if you can't afford that, which is totally reasonable, find some other way to, it sounds strange, but to become vulnerable with each other. Because you will, when you least want to, have to put it all out there because things will get hard. And if they don't, congratulations, you're 1 in a million. But for the rest of us, it's really great to invest in sort of conflict resolution before the conflict happens.
So I like that. So your angel investors can be your therapist too. So I'm not sure what founders share, but they say, when you go to your angel therapist, it's a very safe space. You can talk about anything and they may not even give you an advice, just listen. And sometimes that helps. So there are more values of having a nice angel investor than just the expertise and the capital,
So I want to look at the other side of this conversation, which is the person looking for a job. And we talked a little bit about this earlier, Sahab, but in particular, just as there's a lot of anxiety amongst founders about the future of the economy, folks who are graduating or trying to build their careers, whether it's with an early stage startup or not, are seeing layoffs. They're seeing, scary news about people not being able to pay market salary for X, Y, and Z, and competition, more people applying for these types of jobs, whatever. But the reality is rarely, that, sort of clear. So what are we seeing today, and what advice can we give to folks who are looking to join, a Meta or a Google, or something more like pre-IPO, something a little bit more stable than that early stage company?
Yeah, just looking at my career, just following your interests is super important. So whether you already have a job or working on something, I think you'll have a lot of time outside of work, whether it's weekend, and especially at this day of age, there are so much resource that you can go to, either YouTube or other learning tools that you can expose yourself to what interests you. So whether it's a hackathon, peer groups, I think there are a lot of resources that you can point to, and just pursue that and try to learn as much as you can. I think earlier in your career, I think that's what you should be optimized for. Prioritize your time, and just try different things.
I would say the network, because it is true, right? Like if you sit there and you look at the volume of resume that comes in, like any one position, there's like more than 2,000 resumes, right? Like you just can't spend too much time, and then it is a little bit of a employer market, I guess, like in some ways, right? Where you just almost have to like clear your queue super quickly. Now referral always bump it up, right? Because when you're dealing with such high volume, the ability for someone to speak on your behalf is really high. So to be honest, I have not applied for a job since my first job, right? And so it's been like one after another, which is basically kind of getting introduction to the next conversation, and it's networking doesn't mean that it has to be someone that you've worked with before as well, but someone that is, kind of be willing to speak on your behalf, whether it's you go to a club with together, right? Or you volunteer with together. So getting yourself out there, participating in various different stuff. I think being open with the fact that you're looking for something or is interested would go a long way. And then if you're looking for a job and not really doing anything, I think just sitting at home and sending out resume is going to probably not do as much good as putting yourself out there, meeting people and getting involved in different stuff, right? And it doesn't actually have to be the job that you're looking for, but whether you volunteer, right? Like you get on nonprofit board, help people do different things. It just opens up the conversation and gives you more opportunity.
Yeah, I second that. The networking really pays dividends as your career goes on, and tendentially, like for us investors, cold outreach versus the referral, like that makes a huge difference.
And so when I started my career, I really wanted to do certain things. But I was at a conference, met somebody, they liked me, and they were in finance, and they offered me a job, and finance is the last thing I thought I would work on. And I just liked that person, and I ended up taking my career from there. And anytime that opportunity came in was in an industry that I never thought I would work on. So keeping an open mind and the curiosity, like I want to learn, I want to go and see what's out there. Especially if something is calling you, going and exploring that is great. But one thing that I wish that I did more was actually following my passion of doing my own thing, right? So I always encourage, if you're, like right now, I left my corporate career to do this, what I'm doing right now. It's not easy when you get at a certain point in your career because you get used to it. It's a very comfortable. But when you're young, you're energetic, you're very optimistic about the world. You can do things and you can take risks, which becomes a bit more difficult as you get older. So I wish I took more risk when I was younger and early in my career. So I would say take risks, explore, get out of your comfort zone, try things that you didn't think you would try. If the opportunity comes to you, take it as a sign, try it. You can always go back to whatever your plan was.
Nothing to add with these areas. That was all. I mean, networking, take risks, it's all great. And that's exactly what you should be doing. If you want to hear some really wild stories about other ways to try to get people's attentions for hiring jobs, I got a lot of really dumb ones. So talk anyway, so thanks a lot, guys. It's been awesome. What we'd like to do now is kind of open this up to Q&A. And I don't even have to finish saying, you guys already know. Let's jump right to it.
I'm Kintar Badni. I'm head of blockchain at Carbon Sustain. So I had two questions. The first one about how you said money is getting commoditized, right? I think that's a big topic with the SEC and CFTC arguing whether ETH is a commodity. What do you think is the limit of how much money is going to be commoditized? Or what's going to be the differences that are going to stay even as we explore these things that are changing?
Sorry, in terms of like the limit of commoditization of.
Or I just wanted to pick your brain on what exactly you mean by money is getting commoditized. Because, for example, right now, the CFTC has also claimed that ETH is a commodity. SEC also confirmed that, but now the SEC is going back and saying it's security. And so now consensus is suing the SEC. There's all these things about exactly what you said. Money is getting commoditized. What is changing here? So I wanted to understand more of your perspective.
Okay, if I understand correctly, I think the commodity you mentioned for ETH or blockchain might be a little bit different.
Yeah, that's just the context. Like,
yeah. So what I meant, I clarify like what I meant. Like, there's a lot of capital, especially with the zero interest rates, that there are a lot of like rich people, and especially in the VC industry and investors, there has been a lot of new investors that came out and raised tons of money, especially the top VC funds are billions of funds, but not only that, there's solo GPs and angels. So that's kind of what I meant, that in terms of if you're just looking for money, there are a lot of different ways you can get that. But in terms of like the marriage and partnership and who you're adding to your board, it should be different kind of research and homework that you should be doing.
Yeah, thank you. And then that kind of segues into my second question. We said that like partnership is the way that we found like the founders and the team, right? What are kind of like foundational principles that you would go about establishing these kind of relationships, whether it's emotional, intellectual, or in all these fields?
I would say like style and respect actually come for over time, right? Because I think if you think about a situation where the partnership matters a lot, it's like relationship, right? And so values. I think how you manage conflict, whether or not you can manage conflict with each other, right? And that's a little difficult to tell probably. And my recommendation is like when you guys first meet up and hang out and talk, just be honest, right? It's like don't try to just bring your pretty self, just bring your full self. They either like you or they don't, right? And but like if they don't like you today, they just don't know, they'll find out, right? Like just don't hide things, because I think sometimes in the early interaction, you try to just be maybe the perfect version of you that is only going to show up 10% of the time and not 90% of the time, right? So just, I think, bring your real self, try to uncover theirs, and that's probably a good starting point.
Thank you.
Ellen, totally agree to be honest, and thank you for the plug.
Nice to
Thank
see
you.
you.
Well, great talk, second day, amazing, super exciting. So I'm from Global Worlds, Platform Connect Founders and Investors Without Human Involved, so machine deciding who is relevant to who. And the question is to investors and everyone, of course, two questions. First, right now with AI and everything, it's going to be even more founders who are prototyping, starting building companies and start raising. So now investor claim or say that they are overwhelmed with too much deal flow and everything. But tomorrow it probably be like 10x, 100x from now. Like it's going to be more. So what are the key things you're looking at founders when you pick one out of these thousands that are reaching out to you via like cold outreach via other sources? That's the first question. And the second is like, what are your primary sources for deal flow, like top 3, top 5? Thank you.
So actually, I can give the answer to the first one is when we get the first deal, unless it comes from a person that I know, it's usually, is this a business I want to invest? Does it align with my thesis? Do I think there's a value in the business? So I don't even meet the founder. This is like, you know, in movie theaters, you have, you know, log lines, which says what the movie is about. So think of your value proposition as a log line. And if that doesn't register with an investor, they probably won't go further because they're seeing so many of them. So that's to begin with. And then when it comes to AI, so depending on who your investor, who you're getting to, if they are technically savvy and they understand this AI space, a lot of companies that are coming right now will be obsolete next year. So that doesn't mean that I'm going to invest in that technology. I will look at the fundamentals again. So are you selling me AI? Are you selling me, what is other thing that you're putting on top of it that is going to be your moat because your AI isn't the moat for me? So if those things are not there, then the founders will come in and the founder depends on, you know, you meet, you know, it's also, some founders click, it's also a partnership. But those things have to be there before you even get to the founder gets through. If it's a cold email, those things have to be there.
Yes, for me, since there are a lot of companies, sometimes the metrics and numbers will be the first filter. But once I start the engagements, I personally like to look at the founders and their story. What I call a chip on the shoulder is what I'm looking for. That has a story and has a curiosity and the reason to be succeeding. Like when you're starting a company, you're thinking like you're gonna be in this for like 10 years potentially. I mean, ideally less than that, but so I'm looking for somebody who can go through that steps and people who are willing to pivot but kind of continue in their journey. And in terms of deal flows, it's kind of all over the places. But for me, I think again the referral is probably the highest hit rate and where we see the most interesting founders. But also at the same time, surprisingly, we do a lot of cold outreach as well, depending on the thesis and what we're very interested in, and just researching like what companies are out there, what interesting founders are out there, and yeah, we do that and meet founders that way.
So what is an interesting founder, like when you decide to do a cold outreach? So
yeah, I mean, if it's the industry or the market that I haven't seen before, like starting with the market, and then if this kind of technology that I've not seen before, and then if the founder has the right background, whether highly technical or have done something, maybe not exactly the same thing, but kind of in the same industry and have scaled the ventures before, those are usually some of the good signs that we should look for. And then like going back to the team, I think we try to see the co-founders that kind of complement each other in different skill sets.
It's very hard to know about founders in an email, it's just a cold email. And we don't even know if it's auto-generated, how many you send it to, it's personalized, like you don't know. So like, I mean, for me to go and look at LinkedIn and LinkedIn maybe the first point of view or say, yes, I want to talk to you more to learn about what I need to see in a founder would depend on what's in the email. And that would be your company, the sector that I invest in, and things, or metrics or all those kind of things. And some founders are so good, they just write very sharp. It just takes a minute or 30 seconds to take a look at it and absorb it. And that's the right amount to send out for the full email.
There's also, I think, a lot of like repeat founders, I think, showing up now, probably more than before, right? Like the market somehow is like ripe for repeat founders right now. And I know in general for VC, it's the same with referral. If you don't have referral and you're a repeat founder, the fact that you highlight your repeat founder, you've done this before, I think will probably come. And so it's basically proof point, right? When your volume of entry coming in is so high, the ability to sort of highlight why this requires more attention than all the other you're receiving is essentially powerful.
Or you could add, why do you care about a problem? If you can write it in a line, then maybe, that would help. What was your motivation?
I love that. And the second part of the question, like, where do you source your deal flow? Like 3 to 5 top sources, like where you would go to find your deal flow.
So I'm an angel investor. I get deals in my angel syndicate groups in Gust and Deal Elements, a huge volume. I'm actually thinking of building an AI bot that can use metrics to screen, and then the log lines will come afterwards. And then referrals. I actually do have one repeat founder in my portfolio whom I'm very proud of. And I have actually founders refer other founders. They say, I met this person, or I know this person is starting this, and sometimes those are the best, and I feel like it's a badge of honor to start getting those now. And I actively go out and in the places where I think I'm going to find high quality deals, and there are a few, and then you would go out and then hang out in those areas, strike a conversation. You never know who you find where, so always be on your best behavior.
Actually, follow-up question to that. Where do you go and find those high quality founders?
So I'm in biospace. So last week I was at Bio in Santiago. It's a biotech industry. It's people from corporate comes in, but also a lot of founders comes in. So I was there talking to many founders who were doing something innovative, and many of them were early stage. So that's one thing. Yesterday I was at Databricks. There were a lot of students that are trying to spin companies, met them. So you just have to go. Sometimes the best ones are out there. You have to go to them. So you just you have to be there. I'm not sure how it would be for later stage, but for early stage, it's mostly students or researchers that are coming from universities.
All right, so we've got time for probably 1, maybe 2 more. Any other questions? Yes.
Hi, I'm Andrew. I'm a product designer for founders. Well, I'm Andrew. Thank you guys for coming. I'm a product designer and I run my own studio helping early stage startups and founders. This question mostly for Alan, actually. I've been looking a lot into the banking as a startup field because a lot of my funds are locked up because one of them, bankrupt. Yeah, Synapse. So I actually read this TechCrunch article where the Syncera CEO kind of mentioned how Syncera is kind of approaching it differently. I was just curious, what convinced you to join Syncera? It seems like it's a difficult time.
Yeah, that was a funny question because, just a little bit of background, I was at Pfizer prior to my role here as basically SVP advising our global business services, right? Very cushy job. And so, what happened was I probably was kind of hungry for the early creation, start over again, and then I started looking in the field. When this opportunity came by, there's a couple things that I look for. Number one, do I believe in the problem, right? And so I think the things that I've learned having been in a company that's probably more like deep in core banking is that there are problems that the big established company are not going to be able to solve on their own, right? Because they're so entrenched, it's so difficult to disrupt yourself, they're not going to solve it. And the second thing is I've learned that the trend of money movement and where consumer expect to engage is shifted so much during COVID, right? So early days of Clover, if you guys don't know, it's point of sale. Basically, it's all about we're going to take payment and process full payment. That was like disruptive 10 years ago, right? Now, everybody and their cousin actually does that. Everyone processes payment. Now, the payment is commoditized in some ways. Now, banking is the next thing to get disrupted. So I like the space of like banking being accessible, not only for the banks, because no one's actually going to the branch anymore. So where does deposit come from? Wherever you are, right? And so that problem is something that I feel good is going to be there. And I think secondarily, the established player are not going to be able to solve it. So I feel good about the problem. The second thing I look for, it's not too dissimilar as, I think when folks are looking for investment, this is not a job I needed, it's a job I wanted, right? So I was looking for a team that I could feel good about. So when I met, the Singterra CEO, they have a head of compliance, chief compliance officer, which is the thing you look for if you work with anybody in finance. So if any of you guys are in finance, you don't want to muck around with it. It's highly regulated. So you actually want to find companies that build it into the foundation of how they design their product. Then the final thing is really kind of making sure that from a style perspective, it's a match. And, I believe that the space is waiting to be disrupted. There are going to be a handful of winners that will win within that space. That's for the taking. And it felt like a right size team, right face in the industry. I generally also like markets that is going through a little bit of pressure, because it means you can't just go in and do whatever you want. That's kind of banking as a service a couple of years ago. Everyone and their neighbors are just like doing whatever. Now that it's a little bit more regulated, there's a couple of things that fall through. So the remaining are the ones that are probably got some foundation.
Any other questions? Stretch for one more if somebody has something. Okay, cool. All right, guys. First, thank you again to our panelists for coming out here and being up here all day. There we go. And also thanks to all you guys for being here. Really quick also, so if anybody wants, we'll all be sticking around here a little bit longer, and if anybody else wants to learn a little bit more about product growth or anything else like that, whether a little more tactical stuff or whatever, more along the lines of some of the conversations we had yesterday, by all means, feel free to reach out to myself or Sam at Honest, reach out to us on LinkedIn, whatever works for you guys. But again, we help early stage startups help with growth in a more efficient means through the product, try to help you get to where you need to go. That's it. Thanks, everybody.
We can definitely crowd around. I can say this, but sorry, Zimran.
So we have the space till 3 p.m. and we booked the North Beach Pizza. It's a local restaurant. It's about a 10-minute walk that way, so we can all walk that way and after 3 ideally. But that's for networking and everything. You guys, speakers, talk to each other and all that. But that concludes the speaker panel. So, thank you.
That's really great.
I actually originally wrote
Yeah.
after I left.
Yeah, I'm gonna open my. Hey, Josh.
Yeah. We have
Yesterday.
yeah, exactly.
Hi, Josh.
Nice to meet you as well. I like to think so finding the right time for your product the time consuming.
Yeah, so I this might have been a good.
That's something.
How far along is Berkeley?
test our pipeline. Small armies, so anything up and running. Hoping things are gonna be
I think it does, right? I think especially if you're on an earlier stage, it's actually better. I think if you're going from a B to C round, and things like that, the pressure is a little bit higher there in the case. You're either gonna get acquired or you go IPO round, right? But for early pre-seed, like we were meeting with a bunch of VCs the other day, so I both have been on like the invested side, but just like so I was done with like this batch stuff, like let's go back and let's go build this again, right? But it's friendly, it's so we're all that's matters a lot because there's a lot of people have the table, but I think people are excited to get you're gonna be saying like, right? And I think they can both sway you good and sway you bad, right? Nice to meet you. I want to know if you have I'm really throw down or connections to the startups. Something for too nice. Channel outside for startups to I'm obviously LinkedIn my picture get a little bit but that I was consulted. Like what you guys are I actually like interesting. My current job is with startups, so that was one of the things that was really fun as well, is because a lot of fintech startups and there's a point of sale company also are doing fintech. So it's pretty fun. So it was I think it's the general like idea of it started by a bunch of workers who thinks that core banking is really important to really suck. So they're like, there's gotta be a better way, right? But because it was started by a banker, so when I joined, I actually replaced three roles. The CTO role, and so we decided it's early enough to integrate all of that so people are synergy. But the head of product has been a banker for like 30 years. So he's like such an expert banker. And we're like, oh, that makes a better banker than other bankers actually off, right? And we realized that a lot of the extensions what I said I've seen it being able to work with fintech because nobody's building a branch anymore. So I was like the branch is sort of at the time. So it was actually creates that extension point. And I remember when I was at Clover Day, when we first did the acquisition, first did it on the buy side, and I started learning about all the solutions. I was like, oh, they're like this small business in the enterprise one, right? Like they're not the Chase, they're not the Bank of America, they're not like real, so they're getting started already. They don't have to put any changes, they actually go create their own API, build their own things, so they really are looking more for what I would say we might be able to go over the cycle. You have like a team that business flavor that close to us and like to do it. One of them is like a couple that is trying to rewrite which I was international students because I really like that. Yeah, exactly. They're like, you know, when you want to come to the country, your parents need to send money, but we don't have a pay. Exactly, right. Either that or like there's a lot of like people who are exactly like their families, like things like that. So we're having like
Other question that I have is what kind of technology do you use maybe lower blockchain or do
So I think we don't actually do a lot of blockchain because there's a lot of like actually basic ledger management, right? If you think about like what banking does, it's really customer risk management and managing your ledger and like everything actually adds up and like can reconcile problems, right? A lot of the investment that we feel is actually building up tools to make sure bank can monitor fintech and fintech can slow down a little bit. Because like banks are really slow, fintech's really fast. So like it's funny, like someone asked like Synapse stuff, like what Synapse does is basically say, we're gonna obfuscate everything. Right? We'll take care of everything you don't have to worry about. But ultimately that doesn't work because if you're a customer to bank, the bank is responsible for that customer regardless of where it comes from. Like if they're highly regulated, right? So what you want to do is give the tools for all of the banks to kind of level their operations and run faster and tell the fintech to slow down a little bit, and then the regulatory execution matters, right? So
like the regulation
exactly.
because I know that you can have many exceptions like risk-taking and this kind of thing that it can help to increase customer money.
Yeah, and I think whether it's blockchain or
But it's now it's difficult to do it the same.
Like look me up if you have any questions. I can see if I
Yeah,
can
thank you. I started my project in consensus hosting, and so also my team is blockchain people. Excuse me? Yes, it's a community. I'm coming from Peru. My name is Lito. Nice to meet you. Yes, I was, and also I have been product designer, so that's why I registered for the event. And now I'm doing this. Now I'm just understanding what happened with the ecosystem.
Facebook on Instagram.
Yes. Did you change it? Oh, good.
Oh, you spoke. So what's your community?
I'm close with data.
We ran the immigrant founders event.
That's why I'm coming. Yeah, you have to watch me. Now, nice to meet you in person.
So, you know, you do a blockchain community there. How long have you been here for?
I will stay here 1 month, and then I go into a new city.
We're gonna start doing some crypto blockchain DeFi events here in the Bay.
Actually,
I swore I wasn't gonna do my all day, right? I was like, that is 9 years of my life. I'm gonna do
and also the most fun. If you guys are going to events, get me.
and I'm like, okay, maybe not. Let's see. It's probably
And I'll tell you.
And tonight, it's a fashion dinner for investors.
Your event?
No, I'm connected to the